I'm John Hanna for CityTV.net here in New York City, and we have Greg Womack, President of Womack Investment Advisors, joining us from Edmond, Oklahoma. Good afternoon, sir.
Hello, John.
How are you doing today, sir?
Well, we're doing great. This second day of April.
Yeah. It seems like the first trading day of the second quarter, right?
Yeah. Can you believe it? The first quarter is gone, and here we are looking to the second half of the year, beginning of it, and just exciting.
There you go.
The market's had an incredible quarter. For the quarter's one of their best starts in many years. But it's been a good quarter for the markets, and we'll see kind of what happens with the rest of the year. But when you start out with double-digit returns, it's sometimes pretty hard to top.
Yeah, it's pretty hard to copy it again, right?
Exactly.
All right. So what do you have for us for the Market Week report?
Well, the domestic equities ended pretty uneventful last week by marking the best first quarter for the S&P since 1998. And despite some downdrafts early in the week, the Dow and the S&P managed to stay above 13,000 and 1,400 respectively. And the Nasdaq continued to lead the pack for the year. Year to date through the end of the quarter, which was last Friday, was 8.14% on the Dow, S&P 12%, and the Nasdaq 18.7%. So really, like we've talked about, just a strong quarter overall for the markets. So last week, some of the headlines, home prices in the 20 cities tracked by the S&P Case-Shiller Index hit their lowest levels since 2003. After falling for the fifth month in a row. So, housing prices are still hitting some record levels, so it is continuing to be a buyer's market out there. Then we have order for durable goods. Those that are intended to last 3 years or more saw their fourth increase in the last 5 months. And then we had the final figure for the nation's gross domestic product, the GDP, confirmed that the U.S. economy grew at an annual rate of 3% in 2011's final quarter. Now, consumer spending was up 0.8% in February, but the increase helped cut the savings rate to 3.7. The monthly average for the previous year was 4.7. So consumers are spending a little bit more and they're saving less. Of course, higher gas prices account for part of that increase. So if we look ahead, John, this week it kicks off the new quarter. Unemployment data will be released Friday, though the markets will be closed to the long holiday weekend due to Good Friday and won't be able to react until the following week. The Federal Open Market Committee minutes will also be watched for the groups thinking about any potential actions after Operation Twist expires. And the European Central Bank will review interest rates Thursday, and manufacturing-related data will round out the week. So we've got a pretty busy week, Friday being a shortened week with the markets closed. The Federal Open Market Committee minutes are going to be on the 3rd, along with factory orders, auto sales, the U.S. service sector on the 4th, and weekly new unemployment claims on the 5th, and unemployment payrolls on the 6th.
What are your thoughts now? I mean, we were talking about earlier that it's going to be tough to follow a double-digit gain on one quarter. When you have something like that, do you take out money from the table?
That's a good question. I mean, you always want to look at each individual position. If you're in individual stocks, you want to look at how much of an increase have they had. And if you've had a really nice increase in your holdings, then you definitely want to look at protecting profits. And you can do that several ways. One is by putting in a sell stop at certain levels, say where the stock looks like it has support. And so if it falls through that support, you want to go ahead and take some profits potentially. Or some people just say, hey, I'm going to hit if it goes up another percent or so, I'm just going to take some money off the table. Of course, another way you can do that is to buy put options on your securities, and that way you can continue to hold your securities, 100% of your positions, and the insurance put options, it costs to buy those, and you buy them typically a little bit lower than where they're trading at. But that's an option to get out at a certain price if things were to go down substantially. Of course, I would encourage you to have some experience in options before you start trading those. But so there's a couple things you can do, and there are a lot of stocks out there, John, that have not hit all-time or 52-week highs. A lot of stocks are coming off their bases and moving higher. I'm thinking of many charts I've seen in the last few weeks of energy companies to even some big consumer giant companies that have not had significant upside. And so it wouldn't hurt to be looking at some of those companies to reallocate from some of your gains you've had to reallocate to some companies that are just now maybe starting to move.
When you put in a certain amount of profit mark that you wanted to hit in 1 year, and you hit that within the first couple of months of the year, people always tell to other investors that they would say, you know what, you can take half of it now and just hold on to the other half because you might want to ride the stock going up. I mean, a good example would be Apple.
Right.
Way back when it's only a couple of dollars or something like that, and now it's $600. So
even a couple of years ago, it was even a little over a year and a half, it was trading at around 200, right?
Right.
And so, my philosophy has always been, if a stock doubles in price, if you buy it right, you buy it, where it made a big move, like Apple, and you double it, take some profits. I mean, if you want to take your money off the table, so you put in $10,000, it's now worth 20. Take 5 or 10 of it. You don't know what's going to happen. Market could go through a major correction or whatever, but you take some of that and let the rest ride. And a lot of times I'll put a sell stop on what's left, so you make sure you don't give up all your earnings. But now you're playing with the house money. You got your money off the table, and now it's the house money that's going up or down. And then you take your seed or your profits that you put in initially, your seed, and you go and try to mimic that or do a very similar approach. Nowadays, it's hard, for stocks to make 100% return. It's far and few between. So maybe you do it at 50% return, or 25. Not get greedy, but at least always taking some profits off at various stages, because there's still a lot of headwinds left in this economy and the world economy, and we've seen the VIX, the volatility index, at record levels, at least levels we haven't seen almost since 2007, before the market really started getting ugly and correcting. And so that tells us that there's a lot of complacency, people getting into the market, and at some point we will see a pullback. It could be fairly significant, which is healthy for the market longer term. So you just want to make sure you protect those profits. I like the idea of, especially when something doubles, you definitely get your money off the table, or at least take some significant profits. And you may want to lower that 100% rule down to 50 or even 25, at least, from here. So doesn't hurt to take profits, because it's all on paper until you actually take them.
There you go. That's Greg Womack, president of Womack Investment Advisors, joining us from Edmond, Oklahoma. And I'm John Hanna for CDTV.net in New York City.